Special Reports is a daily show that will cover issues surrounding the economic collapse. All our reports and daily alert news are backed up by source links. We work very hard to bring you the facts and we research everything before presenting the report. Subscribe for latest on financial crisis, oil price, global economic collapse, dollar collapse, gold, silver, Bitcoin, global reset, new world order, economic collapse, economic news, political, geopolitical news. Today, we talk about the bubble as the worst in history. UVE lived through the tech bubble and the housing bubble. So what is next? Put it like this and the answer is obvious. There is only one major asset class left, and its prices are near historic highs. The next bubble is a bond bubble. Bond prices around the world have steadily risen for decades. Conversely, interest rates have been falling. The two are opposite sides of the same coin. The trouble with doubles is that you can't afford to miss out, but you can't afford to be holding the old maid when they pop either. These two emotions end up causing the very behavior they warn against. People pile into tech stocks just when the bubble is defying all logic. Then they are among the first to be wiped out. So what is the bond bubble? Well, it is a more complicated bubble than the previous two. But it is not unprecedented. In fact, recent events are suspiciously familiar. And today's Financial Times has plenty of articles about the bond bubble without realizing it. The world's most famous bond market is top of the news, Argentina. The FT estimates that one of the U.S. major bond fund firms, Franklin Templeton, lost more than $1 billion on its Argentine position alone. Bond manager PIMCO has even bigger holdings of Argentine debt. But what is making Argentine bonds tumble? The biggest worry is whether Argentina can meet its financing needs in the coming years while navigating a looming recession and runaway inflation ahead of a presidential election next year. Oxford Economics estimates the overall funding needs for the rest of 2018 and 2019 at $77 being a challenging number even with the more favorable backdrop. With interest rates at 60% and a currency that have this year, not many people could finance that much debt. The Argentines have tried every door out of the mess in the past. Now they've swung back to door number one, the International Monetary Fund, IMF. The trouble is, this didn't work out so well in 2001, explains the FT. IMF wrestles with history in tackling Argentine peso crisis. But Argentina is far away. And bond investors were burned so many times in the past, it is hardly surprising. Getting a little closer to home, we have Turkey. The currency crisis there is making it hard for companies to repay their debts because those debts are often denominated in foreign currencies. A falling Turkish lira means you need more of them to service the same euro or US dollar denominated debt. For many companies who didn't borrow in foreign currencies, the problem pops up differently. The cost of oil and other commodities is surging as the currency drops, cutting profitability and the ability to repay debt. Last week, everyone was busy analyzing which dominoes would fall of their own accord, triggering the chain reaction. Moody's debt ratings agency downgraded 18 banks in anticipation. On Friday, companies began announcing their missed debt repayments. A vehicle rental firm and an energy firm were among the first, with a power plant going offline. On Saturday, a major Turkish retailer announced it was in talks with creditors to restructure debt. The point is, it is not just sovereign debt that is in a bubble. Corporate debt is too. All roads lead to Rome, and then the ECB. The FT's coverage of the bond bubble continued on to Italy. And Italy is the key. It is too big to bail out, too important to let fail, and too Eurosceptic to control. Britain's ties to the country in terms of trade and financial markets are enough to cause a major crisis at home if there is a problem. Confirming a suspicion I had expected to spend some time researching, the FT declared, Italy has less than 3 months to raise the bulk of its remaining annual financing needs amounting to about 63 billion in fresh debt, as its bond sales program lags behind those of other big Eurozone sovereigns. May's bond crisis in the Italian market spooked politicians. They stopped trying to raise funds as planned and delayed their bond issuance. Now, with Italian bond yields and spreads back near European sovereign debt crisis highs, they're running out of time to raise the money. Italy's Budget Committee president has already made clear he expects the European Central Bank, ECB, to finance Italy's spending. That deal likely be a violation of ECB rules. Not only that, but the coming monthly issue of Zero Hour Alert, due Friday, has another urgent warning. It's about a secret plan to kill off the euro on the sly. You may never know who was really to blame for the euro's demise without reading it. With an Italian budget battle due in October, Italian refinancing needs spiking, an Italian banking system that's exposed to Turkey's lira crisis, and into ECB quantitative easing in support of Italy, and a secret plan to end the euro, what could possibly go wrong? Bond bubbles are different, more dangerous. The bursting tech bubble and housing bubble did plenty of damage. But bond bubbles are very different. They put at risk a far wider range of important things in our lives. Which is ironic given most people know little about stocks, but not bonds. One difference between a bond bubble and the two we had last decade is particularly important. Property values and stocks are a measure of asset wealth. They're reinvestments. But bonds are not just an asset, they are also a liability. They must be repaid or defaulted upon. A drop in bond values doesn't just have a wealth effect, it also has an effect on the borrower. Without that debt, governments and companies cannot function the way we rely on them to. Worse, bonds are how central banks manage their money supply. One of ECB President Mario Draghi's excuses for his unconventional monetary policy to rescue Italy was that a crash in Italian bonds impedes his ability to implement monetary policy. It does shifty reasoning, but it does expose that a problem in the bond market is a problem for monetary policy. There is a very direct and simple way this could play out. If ratings agencies downgrade European sovereign bonds enough, the ECB can no longer purchase them by law. Escaping the fallout of the tech bubble would have been fairly easy, to a great extent. The housing bubble would have been more difficult. There are many reasons to own your own home, even if the price isn't likely to go up. But escaping a bond drought is impossible. Your government, likely your employer, your shareholdings, your pension, and your bank will all be affected directly. You can't just dump your bonds and worry about something else instead. Put all these together, and you can see how a bond bubble threatens more than just your wealth. It threatens the functioning of financial markets, governments, companies, and monetary policy altogether. It threatens the ability to govern. It threatens the continuation of past GDP, not just GDP growth. The coming bond crisis will wreak havoc unlike anything we've seen before. If at first you don't succeed but get bailed out, try again. If the bond bubble crisis gets bad enough, the basic rules of the financial system will be discarded, and politicians will come up with odd solutions. One of which I want to mention mainly for how entertaining it is. In a wonderful example of history repeating, in May the ECB announced plans to securitize European sovereign debt. The idea is precisely the same as securitizing mortgage debt. By creating a pool of government bonds, and then allowing investors to invest in that pool via different levels of payment prioritization, and therefore risk, the total level of risk can appear to fall. By appear to fall I mean that the sum of all parts will be given a lower risk rating by credit ratings agencies, and the average of the individual bonds. Diversification works. The trouble is, just as with American mortgages, the information that investors and credit ratings agencies rely on when building these pools is nonsense. Their default risk is far higher than credit ratings agencies can politically correctly declare. The true purpose behind the initiative is to build a stepping stone towards Eurobonds. These are joint bonds issued by members of the Eurozone in a similar structure to the securitized sovereign debt. This is an initiative we can look forward to in coming months as the bond bubble plays out. Before this is over, gold might turn into a bubble. Famed investor Jim Rogers, chairman of Rogers Holdings, told KitCo News that while he is not yet buying gold at current levels, a rebound in the yellow metal could cause it to overheat. Before this is over, gold could turn into a very overpriced asset. It might even turn into a bubble, he said. Rogers noted that while he holds physical gold, he would not buy more until prices drop below $1,000 an ounce. I am still waiting for $950 an ounce, or something like that, he said. On U.S. equities, Rogers said that current valuations are overstretched, although stock prices could still climb higher on good news. He added that the next bear market could be the worst in my lifetime, and that instead of U.S. stocks, he is looking at investing in Zimbabwe, an emerging market. I am buying Zimbabwe. Zimbabwe was ruined for 40 years by a crazy dictator. There's a new guy, he may be worse, he may be better, but he is certainly different, so you should think about Zimbabwe, he said. Joining me today is Jim Rogers, chairman of Rogers Holdings. Jim, good to see you again. Thank you for joining us. I'm delighted to be here. How are you? I'm doing great. And since about last time we spoke you said that if gold doesn't rally when bad things are happening then the correction isn't over. Now we're up a little bit this Thursday. But what's keeping gold from really taking off here? Jim and Yella, as I've said to you several times before, I'm still not a buyer until gold goes under $1,000 an ounce. I own gold. I hope I'm smart enough to buy a lot of gold when it gets there. But you know, we had a huge blow-off back in 2011. And I've been around long enough to know the huge blow-offs usually take a long time to correct. In my view, that's what's going on. I mean, I'm not a very good trader, but that's how I see the world. So with the tough summer it's been for gold, Jim, and you've said in the past many times that you buy when gold is down. Was that a good time for you? Not yet. I'm still waiting for Bell from $950 or some $950 an ounce or something like that. It may not get there if it doesn't. It's okay, I own a lot of gold, but that's not what I plan to do, Daniela. If it gets there, I hope I'm smart enough and brave enough to buy a lot of gold, because before this is over, any gold is going to turn into a very overpriced asset. It might even turn into a bubble. Let's move on to equities now, and my stock markets, as you know, have climbed even higher since the last time we spoke. Our valuations just overstretched here. It is now a risk or risk-off period. But Danielle, you say markets and many markets in the world that have collapsed, that are down a lot. You're talking about United States stock market. Let's look at the US, believe it or not, that's not the only market in the world. Yet the US market's making all-time highs. I'm not interested in buying any market making all-time highs. And it looks like it might well go higher. Do you know, if Trump comes up with some good news for a while instead of all this bad news, you could have a blow-off in the US stock market, right? Never. One final move. But I'm not smart enough to buy blow-offs. I don't know how to do that. I know we also spoke about how you foresaw or could easily see an over 50% correction happening in the US stock market. Are you sticking to that? Oh yes, going to be worse than that, Daniela. When the next time we have a bear market, and I wish I were smart enough to know when it's going to be the worst in my lifetime, and 2008 we had a problem because of too much debt. And you know, the debt has gone through the roof since 2008. The Federal Reserve in America alone has increased its balance sheet by 500% in 10 years. I mean, that's unheard of. Nothing like that has ever happened in history. And these are crazy things going on. Jim, I'd love to get your thoughts now on the Nasta deal, and unfolding and dismantling. Here you have a risk with that posed to someone's portfolio. Well, if it turns into a trade war, and Mr. Trump keeps saying he wants trade wars, it's not good for anybody. Nobody's ever won a trade war, and trade wars have never been good for anybody. We saw that the Mexicans and the Americans did something recently. But I look at that, what details we have, and I see what's going on here. This is bad for America. It means that prices are going to go up in the United States. How is that good for anybody at all? Maybe there are the details I don't know about. But so far what's being negotiated, Mr. Trump keeps saying it is a triumph. But I'm an American citizen, and at 325 million of us, it doesn't look good for us, from what I can see. Thanks for watching. Tell us what you think in the comments section below.